In today's video, we are going to take a deep dive into understanding lines of credit. At some point, you have either heard your financial institution or your mortgage broker mention words like home equity line of credit, secured or unsecured line of credit, personal line of credit, student line of credit, etc. While all that may be confusing to most people, in this video, we are going to break it down in a simple and easy way to understand. For this topic, we are going to cover these key points. Number 1, what is a line of credit? Number 2, choosing the right line of credit for you. Number 3, pros and cons of a line of credit. And finally, number 4, what you need to know before you borrow. Remember to subscribe to my YouTube channel and hit the notification button in order to be notified when I make further videos. Let's quickly dive in. Number 1, what is a line of credit? A line of credit is a type of loan that lets you borrow money up to a preset limit. You can pay back the money at any time, but you would have to pay interest on that money on a monthly basis once you make any withdrawal. You only pay interest monthly on the amount you withdraw until you pay the balance back in full. Usually, the interest rate on a line of credit is variable, meaning it may go up or down over time. Your credit score may also affect the interest you would pay on a line of credit, as it tells lenders how risky it is to lend you money, meaning the higher your credit score, the lower the interest rate on your line of credit. For some lines of credit, you may have to pay a registration or an administration fee. It is vital to ask your financial institution about any fees associated with a line of credit you borrow. Each month, you will get a statement showing the amount you owe on your line of credit, and you must make a minimum payment every month. This payment is equal to the monthly interest usually, but paying only the interest means that you would never pay off the debt you owe. Number 2, choosing the right line of credit for you. You can either apply for a secured or unsecured line of credit. With a secured line of credit, you can use an asset as collateral for that line of credit. But if you don't pay back what you owe, the lender can take possession of that asset. The advantage of a secured line of credit is that you can get a lower interest rate. A home equity line of credit is a type of secured credit where your house acts as a collateral, and it usually has a higher credit limit and lower interest rate than other loans and lines of credit. But with an unsecured line of credit, the loan isn't secured by any of your assets. Examples are personal lines of credit and student lines of credit. A personal line of credit may be used for unexpected expenses or consolidating higher interest rate loans, while a student line of credit is specifically for paying for post-secondary education. In order for a lender to determine your credit limit and interest rate after you apply for a line of credit, they will ask for a lot of personal information. This is to confirm your identity, verify your finances to ensure you can repay your debt. They will consider your income, your current level of debt with other financial institutions, your credit report, which is your record of paying your bills on time or paying back money you borrow. Most financial institutions usually require a minimum household income of $35,000 to $50,000 to approve a line of credit. Number 3, pros and cons of a line of credit. Before you ever take on a line of credit loan, it is vital you compare the pros and cons. The main pros of a line of credit usually are: A, you will pay a lower interest rate compared to a credit card or a personal loan. B, depending on the type of line of credit and financial institution, you may not be charged setup fees or annual administration fees. And if you bank with the same financial institution where you got your line of credit, you may be able to have any overdraft on your checking account transferred to your line of credit. While the cons of a line of credit are: A, with easy access to money from a line of credit, you may get into serious financial trouble if you don't control your spending. B, if interest rates increase, you may have difficulty paying back your line of credit. Number 4, what you need to know before you borrow. When you get a loan or line of credit with a federally regulated financial institution, you have the right to receive certain information. Your lender may offer optional insurance for your line of credit, also known as balance protection insurance, balance insurance, or credit protection insurance. It is vital to know that you don't need to sign up for insurance to be approved on your line of credit. Although this type of insurance may help cover a certain amount of your loan payments if you can't make them due to illness, accident, death, or if you lose your job. But ensure you read the certificate of insurance to determine what's covered, what is excluded, and the maximum amount of your line of credit that will be covered before adding line of credit insurance. The price of the insurance may vary based on your age and the amount of your line of credit. The price may also vary between lenders. Note that federally regulated lenders, such as banks, can't add optional insurance on your line of credit without your permission. Thank you guys for watching, and bye for now.